Question 1. A registered representative receives an order from a customer to purchase 100 shares of ABC stock at a specific price or better. The customer specifies that the order should only be executed at the end of the trading day. What type of order is this? A. Market order. B. Limit order. C. Stop order. D. Market on close order. Answer: D. Market on close order. This order specifies that the customer wants to buy 100 shares of ABC stock and that the order should be executed at the closing price at the end of the trading day. A market on close order is an order to buy or sell a security at the closing price on the exchange. The keyword, at the end of the trading day, is the clear clue for a market on close order, distinguishing it from a simple limit order, which specifies a price but not necessarily an execution time related to the close. Always pay close attention to time-specific instructions in order types. Question 2. Which of the following statements is true regarding the taxation of municipal bonds? A. Interest is taxable at the federal level but exempt at the state and local levels. B. Interest is generally exempt from federal income tax and may be exempt from state and local income taxes if the bond is issued in the investor's state of residence. C. Interest is taxable at the state and local levels but exempt at the federal level. D. Interest is fully taxable at all levels unless it is a qualified private activity bond. Answer: B. Interest is generally exempt from federal income tax and may be exempt from state and local income taxes if the bond is issued in the investor's state of residence. Municipal bonds, or munis, are debt securities issued by state and local governments, and their interest is typically exempt from federal income tax. Additionally, if an investor buys a muni bond issued by the state or municipality where they reside, the interest is often also exempt from state and local income taxes, leading to what is known as triple tax exemption. This tax advantage is a key characteristic and primary draw for many investors, making tax-exempt a core concept for these securities. Remember that tax advantages are a major selling point for municipal bonds. Question 3. Under FINRA Rule 2210, all of the following are considered types of communication with the public except A. Correspondence. B. Retail communication. C. Institutional communication. D. Internal memos regarding firm policies. Answer: D. Internal memos regarding firm policies. FINRA Rule 2210 categorizes communications with the public into three main types: correspondence, retail communication, and institutional communication, each with specific content, approval, and record-keeping requirements. Internal memos, while important for firm operations and compliance, are not intended for the public and therefore do not fall under FINRA's definitions of communication with the public. Understanding these distinctions is crucial for registered representatives to ensure they comply with communication rules and avoid violations. Think of it this way: if it's meant for customers or potential customers, FINRA wants to regulate it. Question 4. A customer wishes to open a cash account and purchase an equity security. Under Regulation T, how many business days does the customer have to pay for the purchase? A. 1 business day. B. 2 business days. C. 3 business days. D. 4 business days. Answer: D. 4 business days. Regulation T, issued by the Federal Reserve Board, governs the extension of credit by broker-dealers to customers for the purchase of securities. For cash accounts, the customer must pay for the purchase in full by the 4th business day after the trade date, T+4. This rule is crucial to prevent broker-dealers from extending unauthorized credit and ensures timely settlement. Remember that T+4 is the standard settlement period for cash account purchases, and it's a critical compliance deadline. Question 5. Which of the following best describes the role of a transfer agent? A. Executes trades on behalf of customers. B. Provides investment advice to clients. C. Handles the issuance, cancellation, and reissuance of stock certificates and maintains records of ownership. D. Underwrites new issues of securities for corporations. Answer. C. Handles the issuance, cancellation, and reissuance of stock certificates and maintains records of ownership. A transfer agent is responsible for maintaining accurate records of ownership of a company's securities, including stocks and bonds. Their primary duties include ensuring that investors receive the correct number of shares, issuing new certificates, canceling old ones, and handling proxy materials for shareholder meetings. This function is distinct from that of a broker-dealer, who executes trades, or an underwriter, who facilitates new security offerings. Think of the transfer agent as the company's record keeper for who owns its securities. Question 6. A registered representative recommends a portfolio of aggressive growth stocks to a retired customer who states that their primary investment objective is capital preservation and income. This recommendation is a violation of which FINRA rule? A. Rule 2090, Know Your Customer. B. Rule 2111, Suitability. C. Rule 2165, Financial Exploitation of Specified Adults. D. Rule 2273, Referral of brokerage customers to affiliates. Answer. B. Rule 2111, Suitability. FINRA Rule 2111, known as the Suitability Rule, requires that a registered representative have a reasonable basis to believe that a recommended transaction or investment strategy is suitable for the customer based on their investment profile. In this scenario, recommending aggressive growth stocks to a retired customer seeking capital preservation and income clearly goes against their stated objectives, making it an unsuitable recommendation. Understanding a customer's investment profile, including their objectives, risk tolerance, and financial situation, is paramount to complying with the suitability rule. Always put the customer's best interests and stated goals first when making recommendations. Question 7. All of the following are typically characteristics of preferred stock except: A. Pays a fixed dividend. B. Has voting rights. C. Has priority over common stock in liquidation. D. Its dividend is generally cumulative or non-cumulative. Answer. B. Has voting rights. Preferred stock typically does not carry voting rights, which is a key distinguishing feature from common stock, which usually grants shareholders the right to vote on corporate matters. Preferred stockholders generally receive a fixed dividend payment and have priority over common stockholders in the event of a company's liquidation, meaning they are paid before common shareholders. The fixed dividend and priority in liquidation are common characteristics, while voting rights is a characteristic of common stock. Remember that preferred implies priority in dividends and liquidation, but not usually in voting. Question 8. A bond's current yield is calculated by dividing its A. Annual coupon payment by its par value. B. Annual coupon payment by its current market price. C. Annual coupon payment by its yield to maturity. D. Par value by its current market price. Answer. B. Annual coupon payment by its current market price. Current yield is a measure of the annual income an investor receives from a bond relative to its current market price. It is calculated by taking the bond's annual interest payment, coupon payment, and dividing it by the bond's current market price. This differs from the nominal yield, coupon rate, which is based on par value, and yield to maturity, which considers capital gains/losses if held to maturity. Understanding the current yield helps investors assess the immediate return on their bond investment. Question 9. An individual invests $6,000 into a Roth IRA. Which of the following statements is true regarding this contribution? A. The contribution is tax-deductible. B. Earnings grow tax-deferred, and qualified distributions are tax-free. C. Distributions are always taxable in retirement. D. The contribution is made with pre-tax dollars. Answer. B. Earnings grow tax-deferred, and qualified distributions are tax-free. Contributions to a Roth IRA are made with after-tax dollars, meaning they are not tax-deductible. The significant benefit of a Roth IRA is that earnings grow tax-deferred, and qualified distributions taken in retirement are entirely tax-free. This makes the Roth IRA particularly attractive for individuals who expect to be in a higher tax bracket in retirement. The key takeaway for Roth IRAs is tax-free distributions, after meeting certain conditions. Question 10. Which of the following risks is most associated with mortgage-backed securities, MBS? A. Default risk. B. Interest rate risk. C. Prepayment risk. D. Reinvestment risk. Answer: C. Prepayment risk. Mortgage-backed securities, MBS, are subject to prepayment risk, which is the risk that homeowners will pay off their mortgages earlier than expected, often due to falling interest rates that allow them to refinance. When mortgages are prepaid, the principal is returned to MBS investors earlier than anticipated, forcing them to reinvest the funds potentially at lower prevailing interest rates. While MBS also face interest rate risk and, to a lesser extent, default risk, depending on guarantees, prepayment risk is the most unique and significant risk for these instruments. Remember that falling rates make refinancing attractive, leading to prepayments for MBS investors. Question 11. A customer sells a call option with a strike price of $50 for a premium of $3. The market price of the underlying stock is currently $48. What is the maximum loss for the seller of this uncovered call? A. Unlimited. B. $300. C. $4,700. D. $5,300. Answer: A. Unlimited. Selling an uncovered, or naked, call option means the seller does not own the underlying stock. If the stock price rises significantly above the strike price, the seller is obligated to deliver shares they do not own, requiring them to purchase those shares in the open market at potentially very high prices. Since there is no theoretical limit to how high a stock price can rise, the potential loss for a seller of an uncovered call is unlimited. The premium received, $300, only partially offsets the loss, and that naked aspect is the key clue here. Always remember that selling uncovered calls carries unlimited risk. Question 12. A firm's written supervisory procedures, WSPs, are primarily designed to ensure compliance with which of the following? A. Federal tax laws only. B. All applicable securities laws, rules, and regulations. C. Industry best practices, but not necessarily legal requirements. D. Customer preferences for specific investment products. Answer: B. All applicable securities laws, rules, and regulations. Written supervisory procedures, WSPs, are a fundamental requirement for all broker-dealers under FINRA Rule 3110. They are a detailed set of internal rules and procedures that a firm must establish, maintain, and enforce to ensure compliance with all relevant federal securities laws, FINRA rules, and Municipal Securities Rulemaking Board, MSRB, rules. These procedures dictate how the firm conducts its business and supervises its employees to prevent violations. WSPs are the firm's blueprint for regulatory compliance. Question 13. Which of the following is considered a defensive stock? A. A technology company with high growth potential. B. A utility company that provides essential services. C. A cyclical company whose earnings fluctuate with the economy. D. A small-cap company focused on innovation. Answer: B. A utility company that provides essential services. Defensive stocks are securities that tend to remain stable and perform consistently even during economic downturns. Companies that provide essential goods and services, such as utilities, food, and healthcare, are typically classified as defensive because demand for their products or services remains relatively constant regardless of the economic cycle. Unlike cyclical or growth stocks, their earnings are less sensitive to economic fluctuations. Think of defensive stocks as those that help your portfolio defend against recessions. Question 14. What is the primary purpose of a Chinese wall within a diversified financial services firm? A. To separate investment banking from retail brokerage to prevent conflicts of interest and insider trading. B. To prevent foreign investors from accessing domestic markets. C. To regulate the flow of capital between different countries. D. To protect customer assets from market volatility. Answer: A. To separate investment banking from retail brokerage to prevent conflicts of interest and insider trading. A Chinese wall refers to an information barrier erected within a financial firm to prevent the flow of material, non-public information between departments that could create conflicts of interest or facilitate insider trading. Specifically, it separates sensitive areas like investment banking, which may possess confidential information about mergers or new issues, from departments like research or retail brokerage, ensuring that non-public information is not misused. This ethical and regulatory barrier is crucial for maintaining market integrity and investor trust. The Chinese wall is about containing confidential information. Question 15. A customer opens a margin account and buys 200 shares of XYZ stock at $50 per share. If the initial margin requirement is 50%, how much equity must the customer deposit? A. $2,500. B. $5,000. C. $10,000. D. $20,000. Answer: B. $5,000. When buying on margin, the customer pays a portion of the purchase price, and the broker-dealer lends the rest. The initial margin requirement, set by Regulation T, is currently 50%. The total value of the purchase is 200 shares $50 per share equals $10,000. To calculate the required equity deposit, multiply the total value by the initial margin percentage, $10,000 50% equals $5,000. This $5,000 is the minimum cash the customer must provide upfront. Remember, margin means borrowing money, so you only pay a percentage. Question 16. Which of the following is the most suitable investment for a customer primarily interested in preserving capital and receiving a predictable stream of current income? A. Common stock of a high-growth technology company. B. Zero-coupon municipal bonds. C. Highly rated corporate bonds. D. Options contracts. Answer: C. Highly rated corporate bonds. For a customer prioritizing capital preservation and predictable current income, highly rated corporate bonds are generally a very suitable option. They offer fixed interest payments, income, and typically return the principal at maturity, providing a predictable return and capital preservation if held to maturity and the issuer does not default. Common stocks are too volatile for capital preservation, zero-coupon bonds do not provide current income, and options are speculative. Highly rated indicates lower risk, and predictable current income points directly to coupon-paying bonds. Question 17. Which of the following would not be considered a discretionary account? A. An account where the registered representative decides the asset, amount, and price. B. An account where the registered representative has written authorization to make trades without client approval for each transaction. C. An account where the client approves each trade before execution, but the registered representative suggests the security. D. An account where the client has granted durable power of attorney to the registered representative. Answer: C. An account where the client approves each trade before execution, but the registered representative suggests the security. A discretionary account is one where the registered representative is authorized to make investment decisions, specifically regarding the asset, what to buy, sell, the amount, how much, or the price, when to execute, without obtaining prior client approval for each trade. If the client approves every single trade, even if the representative made the recommendation, it is not a discretionary account because the client retains control over each decision. The 3 A's, asset, amount, and action/price, are key if the representative controls any of them without specific client approval, it's discretionary. Question 18. What is the primary risk associated with investing in a limited partnership, LP? A. Unlimited liability for all partners. B. Lack of liquidity. C. High degree of transparency. D. Guaranteed income stream. Answer: B. Lack of liquidity. Limited partnerships, LPs, are typically illiquid investments, meaning it can be difficult to sell one's interest quickly or at a fair price once committed. Interests in LPs are generally not traded on exchanges and require a willing buyer, which can be hard to find. While limited partners have limited liability, a key benefit, and income is not guaranteed, lack of liquidity is a significant drawback and a primary risk for investors considering this structure. The inability to easily exit an investment is a major concern. Question 19. Under what circumstances can a broker-dealer accept payment for a new issue from a restricted person? A. Never, as restricted persons are prohibited from purchasing new issues. B. Only if the restricted person is a family member of a registered representative. C. Only if the new issue is an investment company product, such as a mutual fund. D. Only if the restricted person has a pre-existing diversified portfolio with the firm. Answer: C. Only if the new issue is an investment company product, such as a mutual fund. FINRA Rule 5130, regarding new issues, prohibits restricted persons from purchasing shares in a new issue, like an IPO, at the public offering price. However, this rule specifically exempts certain types of offerings, including shares of investment companies, e.g., mutual funds, and certain other exempt securities. Therefore, a broker-dealer can accept payment for a new issue from a restricted person if it's a mutual fund, as mutual funds are generally open to all investors. Remember this specific exception to the restricted persons rule for IPOs. Question 20. A customer places an order to buy 100 shares of ABC stock at $50 GTC. This order means the customer wants to A. Buy 100 shares at $50 immediately. B. Buy 100 shares at $50 only if the price reaches $50 today. C. Buy 100 shares at $50, and the order remains active until executed or cancelled. D. Sell 100 shares at $50 if the price falls to $50. Answer: C. Buy 100 shares at $50, and the order remains active until executed or cancelled. GTC stands for Good Till Cancelled. This time and force instruction means that a limit order, like buy at $50, remains active in the market indefinitely until it is either executed or the customer explicitly cancels it. It does not expire at the end of the trading day or on a specific date, providing flexibility for the investor. The GTC designation is the crucial clue, indicating the order's persistence. Understand that GTC orders stay alive until filled or cancelled. Question 21. Which of the following best describes the benefit of diversification in an investment portfolio? A. It eliminates all investment risk. B. It guarantees higher returns than a non-diversified portfolio. C. It reduces non-systematic, specific, risk by spreading investments across different assets. D. It reduces systematic, market, risk by investing in a variety of securities. Answer: C. It reduces non-systematic, specific, risk by spreading investments across different assets. Diversification is the strategy of spreading investments across a variety of different assets, e.g., stocks, bonds, real estate, different industries, to mitigate risk. It primarily reduces non-systematic risk, also known as specific or unsystematic risk, which is the risk inherent to a specific company or industry. While diversification cannot eliminate systematic, market, risk, it helps smooth out portfolio returns by ensuring that a poor performance in one asset class or security is offset by others. Think of it as not putting all your eggs in one basket. Question 22. A customer sells 100 shares of XYZ stock short. The initial margin requirement is 50%. If XYZ stock is trading at $60 per share, how much must the customer deposit into the margin account? A. $3,000. B. $6,000. C. $9,000. D. $12,000. Answer: A. $3,000. Selling short involves borrowing shares and selling them, hoping to buy them back later at a lower price. For a short sale, Regulation T requires the customer to deposit 50% of the sale proceeds plus a minimum deposit requirement. In this case, the total value of the short sale is 100 shares $60 per share equals $6,000. The initial margin deposit is 50% of this value, which is $6,000 $0.50 equals $3,000. The margin requirement ensures the customer has enough collateral to cover potential losses if the stock price rises. Remember that selling short also requires margin. Question 23. A customer complains that a registered representative made unauthorized trades in their account. What is the firm's first step in handling this complaint? A. Immediately fire the registered representative. B. Deny the complaint without investigation. C. Review the complaint, investigate the allegations, and attempt to resolve the issue. D. Advise the customer to contact FINRA directly. Answer: C. Review the complaint, investigate the allegations, and attempt to resolve the issue. FINRA rules require broker-dealers to establish and maintain procedures for handling customer complaints promptly and fairly. Upon receiving a written complaint, the firm must review it, conduct a thorough investigation into the allegations, and attempt to resolve the issue with the customer. The firm is also required to report the complaint to FINRA if it alleges specific types of misconduct. Immediate termination or denial without investigation would be a violation of regulatory requirements. Always follow proper procedures when a customer complains. Question 24. A bond's yield to maturity, YTM, is higher than its coupon rate. This indicates that the bond is trading at A. A discount. B. A premium. C. Par value. D. Its nominal yield. Answer: A. A discount. When a bond's yield to maturity, YTM, is higher than its coupon rate, also known as nominal yield, it means the bond is trading at a discount. This is because the investor is paying less than par value for the bond, which, when combined with the fixed coupon payments and the capital gain realized at maturity, since it matures at par, results in an overall return, YTM, that is higher than the stated coupon rate. Conversely, if YTM is lower than the coupon rate, the bond is trading at a premium. Remember the relationship: YTM coupon rate equals discount, YTM coupon rate equals premium. Question 25. An investor is long 100 shares of ABC stock and believes the price may fall significantly in the near term. To protect against this potential decline, which option strategy would be most appropriate? A. Buy one ABC call. B. Sell one ABC call. C. Buy one ABC put. D. Sell one ABC put. Answer: C. Buy one ABC put. An investor who is long, owns, a stock and fears a price decline can protect their position by buying a put option. Buying a put gives the investor the right to sell the underlying stock at the strike price, thereby setting a floor for the potential loss. This strategy is known as a protective put and acts like insurance for the long stock position. Buying a call would profit from a rise, and selling calls or puts would either have unlimited risk, uncovered call, or obligate the investor to buy or sell stock, covered call, short put. To hedge against a fall, buy a put.